Okay, so imagine this for a second. An investing philosophy where the real secret, the key to wealth, isn't just about crunching numbers. It's about understanding the very soul of a company.
That's a great way to put it.
Right. So today we're doing a deep dive into a really foundational text for modern investing, Philip Fisher's Common Stocks and Uncommon Profits.
A classic. Absolutely essential reading, I think.
Definitely. And our mission for you listening in is to maybe help unlock a bit of a mindset shift, moving beyond just short-term bets to really thinking like a visionary
And
investor.
thinking long term.
Exactly. And here's something pretty compelling. We're going to explore why even huge names, legends like Warren Buffett, actually credit Fisher with shaping their own strategies.
It's true. Philip Fisher, he's really seen as, well, one of the founding fathers of modern growth investing.
Hmm.
No exaggeration there.
Okay.
His impact was huge. And yeah, the Buffett connection is key. We often think of Buffett as the value guy, right? Following Benjamin Graham, finding that dollar for 50 cents.
Hmm. The classic value approach.
Exactly. But Buffett himself openly said his own philosophy became a blend. It was Graham's value principles plus Fisher's, let's say, distinct growth approach.
A blend. Interesting.
Yeah, that really tells you something about Fisher's legacy, doesn't it?
It does. So this growth approach from Fisher, how different was it, really, from what others were doing back then? Can you paint that picture a bit?
Oh, it was quite a departure. Graham, as we said, focused on the price. Finding a bargain right now.
Buying cheap.
Right. Fisher. He was looking for companies with exceptional growth potential, almost irrespective of the current price, because he believed their actual value would just keep growing and growing over time. His core idea really was that understanding a company's people, its vision, the culture, its long-term prospects, that stuff was way more important than just staring at balance sheets and ratios.
So looking beyond the spreadsheet.
Totally.
Hmm.
He was basically saying, don't just look at the numbers, look at the story, the DNA of the business. What are its real strengths? Is the leadership solid, trustworthy? Where does it really stand in its market?
That makes a lot of sense. But okay, how did he actually suggest investors get that deeper understanding? Because it sounds like, a lot more work than just reading the annual report.
Exactly.
Mm.
And that's where he introduced this really distinctive research method. He called it Scuttlebutt.
Scuttlebutt. Oh,
Yeah.
no.
And it wasn't about just reading the official documents, the glossy reports. Scuttlebutt meant actually going out there,
Yeah.
talking to people,
Like who?
employees, competitors, suppliers, even customers,
Yeah.
trying to figure out what the company was really like,
Mm.
It's like detective work for investing,
Mm.
gathering intelligence from all these different angles to get a complete picture, often, the unfiltered version, not just the PR spin,
That analogy he used is so good, isn't it?
the marriage one. Yeah.
Yeah. Would you marry someone based only on their resume, Then why invest in a company without knowing its character? It really makes you stop and think.
It absolutely does.
But let's be real. In today's world, everything's so fast, so digital. How practical is it for, say, the average person listening to actually do that kind of scuttlebutt? What does scuttlebutt look like now?
It's a fair question.
Mm.
And maybe it's less about literally knocking on doors, right? But the mindset is what's crucial.
Yeah.
Your modern scuttlebutt could be digging into employee reviews on sites like Glassdoor, reading customer forums to get the real sentiment, analyzing what competitors are saying and doing,
Mm.
even just listening closely to earnings calls, not just for the numbers, but for the tone, the vision management projects. Doesn't sound credible. It's about being sort of an investigative journalist for your investments, looking for clues beyond the official press releases.
Right, finding the story behind the numbers. So beyond just this philosophy, this scuttlebutt idea, did Fisher give investors any, concrete tools? How did he help people actually do this character assessment?
Oh, absolutely. He didn't just leave it as a vague idea. To help with his deep dive into a company's quality, he developed his famous 15-point checklist.
Ah, the checklist.
Exactly. And this isn't some abstract thing. It's a pretty practical, detailed list of qualitative factors he used to rigorously evaluate a stock.
And it gets specific, right? I remember reading it. Things like, does the company have products with enough market potential for real long-term growth?
Yes, that's point one, I think.
And is the management competent? And crucially, are they honest? How good is their R&D? What about their cost controls? Are they actually efficient?
Precisely. These aren't just financial metrics you can pull off a screen. They're questions about how the business actually works, the operations, the people driving it. It forces you to understand the business from the inside out, or at least try to.
It really pushes you beyond surface-level analysis.
And what's kind of amazing is how relevant it still feels. He wrote this in 1958.
Wow.
Yeah, but those 15 points, they're just as critical for evaluating businesses today. The core questions about, quality, management integrity, future potential, those things don't really change, even if the industries look completely different.
It encourages a level of homework, of due diligence that maybe a lot of investors today tend to skip over.
I think that's fair to say. It's definitely more involved.
So, okay, you've done all this work, you've done your scuttlebutt, you've used the checklist, you feel like you really understand this company's character. What did Fisher say to do next? Was it about timing the market, trading actively?
No, quite the opposite, actually.
Yeah.
He had another kind of golden rule, and it went directly against the short-term trading mentality that was, and still is, pretty common.
Mm-hmm.
His advice was, buy right and sit tight.
Buy right and sit tight. Simple, but not easy.
Not easy at all. He was a huge believer in long-term thinking. His whole philosophy was really different from quick speculation. He argued for holding on to high-quality growth stocks for, well, not just years, often decades.
Decades, that requires serious conviction.
It does. And patience, which connects directly to that other big point he made.
Or one about waiting?
Exactly. That the real money is made not in the buying or selling, but in the waiting.
Yeah, that really hammers home the patience aspect. It's about letting the power of compounding work its magic, right? Letting your returns generate their own returns over long stretches of time.
That's the core of it. If you've done your homework, your scuttlebutt, and you found a genuinely great company run by great people, then time is your biggest advantage. Just letting it grow.
So wrapping this up a bit, what does all this mean for you, the person listening right now, this deep dive into Fisher's common stocks and uncommon profits? It isn't really a how-to guide for getting rich quick.
No, definitely not. It's more of a timeless philosophy, really. It's designed to sharpen how you think about investing, to help you spot those uncommon returns in common places, that the title suggests. Fisher's ideas, they really teach patience, discipline, and maybe most importantly, the value of research that goes way deeper than just the surface numbers. It's about understanding why you're buying something, not just what you're buying. And I think whether you're just starting out or you've been investing for years, his approach can genuinely broaden how you think about what makes a truly great investment. It nudges you towards a more profound understanding of the businesses you might put your money into.
So as we finish up here, maybe something to think about. If investing, like Fisher suggests, is actually more human than we think, how will you try to understand the character of a company before making your next investment decision?